Hello, everyone. Today we're going to talk about tails, power laws, distributions, and trying to understand that the market is not normally distributed. It's has an overlay of a power law. And I did some deep dives into this so I could understand it, and that way I can help others understand it. Now, I may not know everything, but hey, at least we can work through it. And so here's an example of a power law rather than something that's normally distributed. Okay, so what we're going to do is we're going to ask everyone in the conference, there's 1,000 people, we're going to ask them what their net worth is. And we can chart this by a bell curve, right? So some people have a net worth of 700 to 750K, some people have 250 to 300, and you get this, what looks like a normally distributed distribution. And most of the finance world acts this way when they create a distribution chart. And so they think the returns are normally distributed. But what happens when Jeff Bezos walks in? This is a classic example to show you the power laws. What happens to this bell curve? Well, he's probably worth more than 100 billion, but I click this and the curve doesn't even exist anymore. You can't even see the curve. Why? Because it's a power law. It's not normally distributed. But the rarity of that person exists, but you're not seeing it in your sample size. And this goes into how the industry looks at models they use to determine what asset classes they should be allocating to. And those models tell you that risk is volatility. And if you're allocating to something with a lot of volatility, you have a lot of risk. And what tends to happen is they start allocating money to quote unquote less risky things. And in order to capture returns on that instrument, you get leverage into that instrument. A great example is foreign exchange. So here I found this website, the distribution of percentage return since 2008 on the Euro USD. And even here it's funny, they say it's normally distributed, which it's not. And you could see here that a lot of the observations have this big fuck you bar, basically 0%. So on any given day, the euro isn't doing anything. And because of that, in order to capture any type of return, you get leverage into it. You could see this on like foreign exchange brokers for retails and things like that, where you get 1,000 to 1 leverage on $5,000 in equity. And the reason is because you need to leverage into it, quote unquote, to make any money, but you're not changing the distribution of the returns by leveraging into it. All you're doing is magnifying the variance of the distribution. And another thing on here that's very interesting is that when you look at a normal distribution, people are looking at it as the expected return, right? But the real expectation, the real return, is the deviation from the expectation, right? So if people say like, oh, I'm expecting a probability of 0 to 650K to be 82.9%, right? Down here, oh, there's no percentages down here. But like like if I try to do cumulative return from here, 62, 73, 82, so a 20% probability that I would have a return or an estimate between 500K to 750K, or whatever that number was. So they can calculate their expectations of that equity's return. But things aren't normally distributed. They're power laws, like we said. And so when you get one of these big outlier events, the whole model's dead. Your expectation, what happened is the deviation from the expectation. And it gets worse that net worth, well, typically net worth, but more something like portfolio returns can go negative. They can go in the other direction, right? And so this has an interesting concept that various people have employed, where what you're essentially trying to do is limit your downside, but capturing the power law to the upside. And an example here is, let's say you have a portfolio of $250,000 and current interest rates are sitting at 4%. Well, you're going to get 4% of carry every year on your portfolio. And the idea here is you take that carry, right? And what is that? Eight, nine, $10,000, right? I think that's what it is. And you take that $10,000 and you allocate it to the power law of tails to the upside. And I'll get into details of what that means, but you can kind of simulate what the portfolio will look like. Now, these aren't entirely accurate, but the whole point of me demonstrating this is the power law, because these are accurate because they're just modeling the power law. They're not really modeling what the expectation of the portfolio would be. But I want to show you. So these numbers are kind of BS, but the curve is the same. And what I mean by this is that your portfolio principal can never go below what you're spending on carry. But the power law of the tail explodes higher. And you could see like these are the power law showing up in the wing payoffs, right? And what that means is that your best return is still yet to come. That's what that means, right? As you accumulate more money from the tail, that's your alpha, it cycles back into the carry, and then you have more money to spend on the tail, which cycles back into the carry, and you go back and forth, back and forth, back and forth, back and forth. Now, this doesn't work in a 0% interest rate environment, of course, but the higher the interest, the better for your tails, because now you have more money to allocate to tails, right? And so the idea here is that the size of the entry of the tail can increase with the size of your portfolio, but it's typically fixed. And let me give you some examples. So this is a current screener of the tails. And let's say I have a $100,000 portfolio, and what I'm going to do is allocate $500 per tail, flat for now. But every $100,000 tranche, I'm going to move my ticket size up $500. So 200,000, 1,000, 300,000, 1,500, right? So I'm sizing as the portfolio grows. And at some point, you're going to have trouble because you can't really allocate 50,000 contracts to a tail. The market's just not going to allow you to do that. So there is a cap on this at some point. But what does this mean? Does this mean we buy every tail? No, it doesn't. We're trying to buy, the screener looks for equities who've had a lot of realized vol in the past, and the expectation is you're going to get a lot of realized vol in the future, right? That's what that means. And it's not normally distributed. It's based on a power law. It's like an overlay of a power law. And what we do, like the current strategy of backtesting is, it's 270 to 780 days. Anything before that and anything after that just fell off in performance, right? And for various reasons. But what you typically do here is we're looking for a 10 delta primarily, but we can accept anything between a 5 delta up to a 12 delta. And those are your wings that you're going to spend your carry on. So right now our carry is $4,000. One of our tickets is $500, which might be a little bit thin, right? But we look at this 539. Is there a 10 delta? Nope, 38. Okay, can't trade it. 504. No 10 delta, can't trade it. And then there's no expiration greater than 270. So we can't trade Alignment Healthcare right now, right? Let's go to now. Well, 868 is too far out, right? Anything above that fell off. And I think the reason here is you had so much, if the tail actually works, You get so much volatility to the upside that at some point correlation starts to hit one, and that screws up all of the VAR models that people use, and then you get dramatic crashes. And that's why I think longer term hold durations don't work very well. And remember, these trades cannot be cut off. You can't cut off the tail. They're power laws, meaning that your highest rate of return is still yet to come, which means you can't cut it off. If you cut it off here, you just got rid of 80% of your return profile, right? Because that's the power law distribution. So you can't cut the tail off. You have to hold it till expiration. And if you're in the money, close it at expiration, right? So you can't cut these things off. So it tended died out over 780 days or so. So I don't trade those ones. 539. Well, that's our next valid one. Well, look at this. We got a crap load of things here. 21 delta. Nope. Go down. 321. Aha. 12 deltas up to 8 deltas. So those are all valid. Now there is a constraint on the distance from spot. And the distance from spot that seemed to work well is you have to have at least 40% higher, or else it's not really a trade, a tail, something's mispriced or really off, and those don't perform very well. Maybe like they're illiquid instruments or something. But anything over 160% or 150%, somewhere around there, you start to fall off really badly in your performance because, well, think of something that's like 300% and you're going to buy it over a year. It has to go up 300% in a year. The likelihood of that is very small. It's probably not a 10 delta, right? And so, but I found this in the 13 years of backtesting that there is a cutoff that works well, and it's around 150%, 160%. So if you take spot 111.22, 111.22, and we go up 160%, it's 289.17. And so the 289.17 would be this one, the 288. And what you'll notice is that a lot of the 10 deltas come out to around 1% premium or less, somewhere around there. They tend to do that, but they cluster around there. What I mean by that is it's $242 to buy the 288 strike, right? So that's less than 1%, right? And what you typically do, remember, like we have a $500 cap, so we can only buy one of these. So you just buy one, right? And that is you trying to capture this upside tail and power distributions. And what's kind of interesting about like now has both extremes. This is on the low end of DTE and it's on the high end of the strike. So this one is probably not the greatest, but I'm not going to argue with the model because the model allows these. So I'm not going to argue with it. I'm not going to do anything. But a human, if I'm looking at that, I would never buy it, right? Because it's just at the low end of the days to expiration and it's at the high end of the distance from spot. But that's okay. That's the whole point of tails and power laws, is that you could see, like, let's say it just went to 300, for example. Well, that's a decent return, right? 288, it was at the 288? I can't remember. 12, 6, that's a 6x return, right? If it just went to 300. So if not, we lose $250, but that was paid for by the US government. Thank you, US government. Okay, so I think that kind of makes sense here. But now I scanned all of these because I have a bot doing this. It does it daily. It runs the screener, and a lot of it's deterministic. The bot's not really doing much. And if anything lands within there, it'll try to purchase the contract. And so I did buy a now contract in this range. It did find it and it did buy it. And what's interesting there is software is the industry that's being shorted against the AI trade. So what's kind of interesting there is that, going back to correlation, is that if correlation starts going to 1 up for all these asset classes where they're doing this long short equity trade, you're going to get covering in the software to the upside and the AI names to the downside. And that's what we just saw with that situational awareness fund. There were long AI and short software, and that's what's been driving most of the returns, the opposite of that since July. And so it's interesting that all the software names are coming up with underpricing of tail volatility, right? Maybe that's an interesting thing. So let's look at one that did pretty well and see if like that fit Dell was one. I think it was on 21. I think it was here. So let's walk through the process. Well, 730 we can buy anything in there. 21 Delta, can't buy it. 695, 21, can't buy it. 604, 27, can't buy it. 512, 24, can't buy it. 359. Oh, here we go. So we got two of them. So look at this one. 11 Delta is about 1%. See? 8 Delta is much less. But we picked the one closest to 10. In this case, it depends on the sort order of the bot. And it's probably going to pick the 11 Delta one because I think that's how it's sorted. But the 8 would also be valid. So you'd buy one of these. You just buy one of these contracts. And so, let's just say we bought the 230. So I'm going to put that on there. And so I have this Dell 230, right? And that's out till January of 27, 359 days. Well, it's not 27, so this contract still exists. It's the 230 contract. And if I go to today and I look at the January 27 here at the 230 contract, it's worth $19,600. So we spent $250 and made $19,600 in 200 days. Right? That's the power law. That's the tail event kicking off on underpriced volatility. And we still have 168 days. So maybe the trade fizzles, maybe it doesn't, maybe they have good earnings and the stock accelerates higher. But remember, we double our entry. Our entry was $243. So we double our entry every $2.39. It's a $407 stock, right? So if it goes up $100, what is that? Just 25% or something like that? If it goes up to $500, that's crazy. 500 divided by 250 is a huge multiple on your entry, right? So these are the power laws that we're talking about in the tails. And they're very important, but that's really what I wanted to nail down is that also like on this Bell distribution is that there's no potential of catastrophic loss. Now, it really depends on your portfolio size. If you have $5 million carrying a 4% interest, well, that's good because like you're going to have more opportunities to buy tails, and you can position larger. But again, like I said, you're going to get a cap, but you're never going to risk the principal. All the returns come from the tail, right? The wing payoffs come from the tail. And anyway, so this is what I've been fascinated about in the stock market is that sometimes you get suppression of volatility in the tail, where another thing here that I might go into a little bit of detail about is the pricing of the tail and the curve distributions. And what I mean by that is, let's go to AMOA. I'll just look at the volatility thing here. Okay, so when you get out into the tail, way up here, it becomes almost impossible, not entirely, unless you have a lot of computers. It becomes very impossible to price the tail correctly. Why? Because one, there's very thin trading. Two, there's something called arbitrage-free constraints. There's something like put-call parity. Also, as well, is that when you get a steepening of the put wing, you can't really raise the call wing at all without creating some arbitrage. And so typically when an equity is crashing, there's a lot of downside put protection coming in. All the calls are being sold, but you can't really lift that call wing mathematically because you can start arbitraging things, right? Maybe like zero cost collars and things like this, right? Where you could just lock in free money or free protection. And and so you could see like the band on these tails up 100% are very wide because it's almost impossible to price these. And that's what happens, is that it's almost impossible to price them purely on a mathematical level, not even on a level of just like what people expect the future to unfold with, right? They'd like models are not taking into account things like that, like, oh, like maybe Dell turns around and starts making billions of dollars. These mathematical models are not thinking about that, right? They're just trying to price things based on some SVI model or some curve fitting model, a linear extrapolation or whatever, and they get it wrong. And that's where you come in and capture the tail. And I think why there's a lot of alpha in this position is because most funds, when they're in the billions of dollars, they when they allocate to a strategy that works and people start finding it out because you can scale into it, then other people get into that trade and the alpha starts disappearing. So as you can scale into something that's profitable, the alpha starts going away. And that kind of goes into like our power laws and things like this. But on these wings, it's not really scalable because at some point, if you have $20 billion, you get 4% interest from some treasury bill, whatever. And now the sizing of one of your positions is millions of dollars. You can't buy 75,000 contracts in any liquid instrument in the tail, right? You just can't. It's just not plausible, right? So it can't scale with size. And that's why I think there's alpha there, is because the industry just doesn't care about it, right? Now you can employ this in different ways. There's Z, I think the guy's name is that he would have this 90% strategy in treasuries that actually yielded. But I think this was from like way back when yields were like 10 or 12%. And then he would buy leaps, long dated leaps on the S&P 500 as to participate in the upside. But there has been papers that have come out saying that that just doesn't really provide any alpha at all because it's already part of the premium, right? So, but I really like this idea of convexity, and you can actually see the power law show up in these tails, right? And so I hope that video was interesting, and I really think more people should start looking at these tail ideas and basically betting on things that no one would expect, because that makes sense, right? Everyone has expectations based on historical distributions of returns, but the real profile comes from the unexpected. And that's why you get a power law. And in fact, there's layers on top of this power law, is that typically when an equity or regime or whatever, a theme is doing well, more money piles into it. And if you're already in the tail of that distribution before it happens, then that money coming in is just your power law. That's where all the money comes from, right? So it makes sense. And that's what I've pretty much moved to now. I moved to this idea of just buying tails. And my original approaches were not, they're kind of tailish to a degree, but they're capped. And so they can't really be a tail if they're capped, right? Because you're not compounding on the convexity of the unexpected to the upside or downside if you're doing puts. And so, the spread strategy I think tends to work, but you're not going to get the type of compounding that you typically would with a particular tail strategy that's funded by carry. And so that's what I've moved to. And I'm going to be doing a lot more work on this, maybe finding other strategies or kind of ways to also hedge against events with drawdowns. Like 2022 was a drawdown year in this strategy, but the amount of returns that typically come from that drawdown were not because you typically sold a position, but it's just everything was drawn down during the event. And as the market recovered and pushed up, everything came back, right? And because you're buying leaps, right? And most of those events happen in March and they're like, 3-month events or whatever. And then the Federal Reserve or the government steps in and just prints a bunch of money or papers over it and the market goes back up. So I like this strategy. I'm gonna be applying it more, and I'm really gonna start working on how to reduce drawdown effectively. And the only way I found to do this, is based on position sizing. Why? Because the convexity that we're buying, sorry, I'm not really sure, I'm just talking here now, but the convexity that we're buying, if we just go over here, this is all the convexity. You could see that it's convex to the upside, right? This convex power law the downside there means returns. So that's like bigger and bigger and bigger returns, is that the drawdown is the convexity. And the only way to have less drawdown is to have less position sizing, right? But the compounding path is to be able to allocate more to these trades when it's you have opportunity. And one way I found to do this is during large volatility events. So part of the strategy here is that large volatility events, there's only a few. And I mean a few, like, something over 30, right? So mid 2015, maybe 2018, COVID, right? 22, somewhere in there, right? That was the mega cap pullback, inflation stuff. And then we had the taper tantrum and all sorts of things, right? But the idea here is that during these large volatility events, you can 3x your starting position size. So if it's 500, I'm now going to move it to 1500. And if something passes the screener and the constraints you have, you're now kind of like, quote unquote, you all allocated more to the convexity when things are at their worst moments in time. And remember, when you get a lot of volatility, well, you expect a lot more volatility in the future, right? And if they're underpricing that vol to the upside, that's where you come in and buy it with additional allocated capital. And I did find that dramatically increases the return profile, the CAGR, but it's monotonically impacting drawdown. And what I mean by that is that's exactly what I said, is that the position sizing is the drawdown. And so if you can scale this effectively in tranches, then you can limit your drawdowns, and you just sit through them. Basically, the history says you just sit through them. Who cares? Like, whatever. Something's down 10%. You just bought it today. Something's down 10%. Who cares, right? Like, you're just holding these to expiration, waiting for these types of tail events. And the backtest actually revealed that the 10 deltas, which theoretically means the cumulative normal distribution, says that option has a 10% probability of being in the money. But the winning percentage of the strategy is 25%. And that makes sense, because if the strategy worked, then you would get more than 1 to 10 winner, right? In this case, you're getting 1 to 4. So I really like this strategy, and I'm going to be talking about it more. If you have any questions or ways to search for these things or find them and things like that, let me know. Talk to you guys later.